Yeah, welcome to today's webinar. This is unlocking the basics of options. You can see myself and Koen here. I'm just giving you a quick intro, and then Koen's going to deliver the session. Just a couple of things for me to point out. So firstly, this is actually the first of two parts. There's an advanced options session, which is going to be in 2 weeks' time, so May 15th at the same time. So please feel free to sign up to that. That's available inside the Saxo platform or on our website, so the same place you found this one. And then, this is an interactive session in some ways, so there will be time for questions. So if you want to ask one, if you're on a desktop, at least on the right hand side, you'll see a questions section. Feel free to pop one in. I think on a mobile it's somewhere else, but you'll find it. And then also the slides that Koen's about to show are available for download. So if you go to the handout section, which is next to questions, you'll be able to download the PDF. And then just finally, if you want to re-watch this session, obviously there's going to be a lot of information shared, then the same link you just used to join, it is the same with all of our webinars. You can use that once it's finished to watch it on demand at any time. So just find the same link you joined with and click that. Okay, cool. Well, that's enough for me, and I will hand it over to Koen.
Thank you. I assume everybody is seeing my presentation screen where it mentions unlocking the basics of options. Welcome. So today, first of all, my name is Koen. I work for Saxo as an option strategist. What does that mean? I write about option strategies. I help clients in figuring out which option strategies to use. And in general, I try to inspire people to use options. Let's have a quick look at the agenda for the session of today. We'll first talk about what are options. I assume that many people are more or less investing using stocks, and that's the premise I'll be using today, that you're a stock investor. It could also be a forex investor, a forex trader, stock trader, rather than investor. Anything is possible, but we'll go from this point on as being an investor, because most people start with buying and selling some stocks. So we'll discuss first what options are. Second, what are the benefits of trading options? Thirdly, the types of options, then some basic option strategies. And then I'll have a short mention about the Greeks. What are they? We'll get there. And then we'll have a look at the actual Saxo platform. I'll do a small demonstration on the Saxo Trader Go platform. After that, we'll have some time for questions and hopefully some answers too. I'll do the first 5 topics in about half an hour. Then I'd like to make a demonstration of about 10 to 15 minutes, and then we'll still have some time for your questions and hopefully my answers. Okay, let's go. Before we start, I have to legally mention this disclaimer that everything you learn in this webinar is really for educational purposes and definitely not advice. You always have to do your own due diligence. Be sure that you know what you're doing, and if not, before you do, go do some research yourself and make sure you know what you're doing, especially that you know what the risks are. Once again, this is for educational purposes. Okay, what are options? Well, options are a derivative. Unlike a stock or a currency or an index, those are real assets, and an option is a derivative. It's a contract. It's not something physical. It's not tangible. If you have a share, that really means that if you have 100 shares, and why I'm using the number 100, that's because most option contracts cover 100 shares. If you have 100 shares of a company, you have something tangible. It's yours. You have a part of a company. An option contract, on the contrary, is just a contract. It's not. It doesn't correspond to something physical. It is just a contract between you, the buyer, and the option seller. Uh, this way, we are already discussing a bit further. An option is a contract between two parties. If you buy an option, you bought it from somebody who sold it. And that's not the company, it's another investor. Who that investor is, I don't know, you don't know, nobody knows. You can be sure there is somebody on the other side. And that's a whole quite complicated structure behind it with clearing houses and intermediate brokers and whatever. But the fact is, when you buy it, there is somebody else who sold it. If you look at the definition here, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset or financial instrument at an agreed upon price on or before a specified date, depending on the form of the option. That's quite a lot to comprehend, but it actually means if you buy something, and yeah, maybe wasn't clear at the start of the webinar, we'll mainly discuss buying options, and you can sell options too, but we're mainly going to discuss buying options. Why? I'll tell you later. That's mainly because of the risk aspect. If you buy options or buy option strategies, your risk is always defined. It can be bigger than the amount you invested in. When you sell options, that's a completely different story. There you can actually lose more money than you invested. So, an option contract gives the buyer, you, the obligation to buy or sell. So that means you can have the right to buy something, but you can also have the right to sell something, an underlying asset or financial instrument. In this case, we're mainly talking about shares, but it could be indexes, it could be forex pairs, so currency pairs. Um, uh, yeah, actually, if you take it off the stock exchanges, it could also be an option on a house, whatever. So, if we look at the risk and return graph of the shares, this actually means that it's quite linear. If the price of the share goes up, the price of your return go up. Your returns augment. If the price goes down, well, your returns go down. Quite linear, quite, yeah, straightforward. Up is good, down is not good. With options, though, options have the very nice ability to do anything that you want. You can start at a certain price, and you can, yeah, you can add other options which do contrary things to what you can buy an option, a call option, to speculate on that the price of the underlying goes up. But at the meantime, you could sell, for example, a put, and that in combination you have countless combinations which all lead to something spaghetti-wise, as you see here on the graph. And then, yeah, of course, your first reaction will be, why would I do that? Well, uh, we'll cover that in a couple of minutes. We have some unique abilities. You can buy options that speculate or uh, count on the fact that the underlying will go up, but you also have options that count on the fact that the price will go down. Or using those combinations, you could bet, and I don't like to use the word betting because it is not betting, but to a lack of better words, You can also do some combinations where you could make money if the stock price just stays in a range. It goes up, it goes down, and it just stays where it is. It doesn't do much, and that could also make sure you have profits. Using options, well, you can really, as just mentioned, you can invest in a stock where you think this stock is going down. It's going down. I'm so 100% sure it's going down. So I want to make some money. Using options, that is all possible. What is an option and how do they work? As we mentioned, we have an option contract with the definition a bit bigger here. What is important to know? You have a buyer, you have a seller. In this webinar, we mainly talk about the options buyer, where you buy from the option seller. You get the benefits from the option, and for that you pay a premium. What are the benefits of the option? Is actually having an option is quite actually the same as having the underlying stock, because you buy the right to buy the underlying stock at a predetermined price before a certain date, the expiry date. If the stock goes up, you will have that benefit just as if you would have the stock itself. There is a difference though. You don't, for example, you don't have voting rights if you have options. But you get the benefits of the option, and for that you pay a premium. And that premium goes to the options seller, the person at the other side of the contract. He's actually taking on that risk. If you think that a certain stock will go up and you buy a call option, well, the person who sells that options contract to you probably thinks that stock won't go up, or at least not as much as you think. And for that, he takes on the risk, he receives that premium. So, being an options buyer, if you buy an option from an option seller, that will give you the right to buy or sell the underlying at a certain price. And buying options is call options, selling the underlying is using put options. I'll get back to that in a later stage. The option seller actually takes on the obligation to accept your decision by the buyer, you, as long as the contract is valid. What does that mean? If you bought an option and the expiry date, and we're now the 1st of May, and you have we're the 1st of May, and the option runs till, just saying something, 17th of May. Of course, the 18th or the 19th of May, you don't have to say, yeah, but now I want to buy my my underlying stock of that option. Of course, at that moment, your option is no longer valid. The contract is void. And what we see here, we have buy or sell options. In this webinar, we'll just talk about buying, not selling, with a small exception a bit later on. And we buy a call or a put at a certain price, which is called the strike price, before or on a specified date, in this case, the expiry. What are some of the benefits using options? And we'll go a bit further into the specifics of the options themselves. First, let's have a quick look at some benefits. Well, trading options for investors or traders alike is, of course, a versatility in trading strategies. What do I mean by that is, in this webinar, we'll discuss simple strategies as buying options, buying calls, buying puts, nothing special, but using options, you really have And we're talking about buying calls and puts, but you can sell them also, calls and puts, and you can give that right to somebody else. And if you start combining, even as an option buyer, you have different strategies in which you can really mold everything how you want it to have. And you could say, just to give a small example, you don't have to understand it, but if you buy a call and you're betting on a rise of the underlying stock, but you could also buy a call debit spread, which is actually a combination of buying a call and selling a call at the same time. So in order to actually reduce the cost of your call, maybe I'm running ahead of things. It just shows that you have so many different possibilities using options. Of course, a second benefit is also you can create some kind of leverage. Why? Well, let's go back to the basic option definition. You paid a premium. In the previous slides, we showed you paid the premium to the option seller. That premium is much less than the actual stock. Let's just have an example stock ABC. Fictionary company, we call it ABC, and the stock price is at $100. And you think that the price will go up from $100 to, I don't know, $130. And for that call, you pay, for example, $10. Now, imagine that the price goes in effect from 100 to 130, and you paid $10 to have that right. That means that the profit you made on the stock from 100 to 130, $30, you also have with your option. Yet you didn't pay the $100. You only paid $10. So you paid $10, you make $30, you actually, tripled your investment with a lot less money than the cost of the actual underlying stock. So it's a very cost efficient way of investing, and could be much more interesting than buying the actual shares um, rather than buying the shares. Sorry. So another benefit of trading options is, of course, risk management and hedging. So just as you would buy a call option, and we'll go into the specifics of call and put options in a second, just as you could buy a call option to speculate on a rise in the underlying price, you could also use an option, as for example, a put option, to do some insurance of your stock. Imagine you have again stock ABC. It went from 100 to, let's be optimistic, it went to 150. Now you say, oh, I made a nice profit, but I don't want to lose that profit. How could you do that? Well, if you buy, for example, a put option, and that gives you the right to sell something, that means that you will make money if the price of the underlying, the price of the stock, goes down. Well, if you buy a put option and the price is high and the price starts to go down, you will make money on your put option while still having your underlying stock. So using a strategy like this, which is very simple actually, using a strategy like this will protect your profits. So it's not only a way to make money, it's also a way to protect your profits that you made. Other benefits of trading options, income generation. I'll cover that very shortly. It's used very often to generate income, but for doing that, you'll have to sell those options. That's not covered in this webinar. However, I did mention it for the simple reason that you could do it as an investor. You could sell covered calls. And usually selling options entails much more risk. But if you have the underlying, as in covered calls, I'll explain a bit later on, you actually generate income by selling options without taking big risks because you have the underlying stock if you have to fulfill your obligation. Other benefits of options is access to broader markets with less capital. Well, imagine you don't have a multi-million-dollar account, but you do want to invest directly using options in, for example, the SPX, the S&P 500 index, or the Nasdaq 100 index. If you would do that directly, often you'll need big accounts, and using options, you don't need that much money, and you can really access markets which are otherwise not available. Strategic exit and entry points, that's also a very common used way of using options when you're investing with stocks. You can actually use options to get into the market and buy stock by selling in the money put options. Maybe I'm sounding a bit too difficult right now. And then you could also actually get out of your position by selling calls, the covered calls. Those are ways of, you can use options which you wouldn't be able to do otherwise. Okay, what are the most important types of options? Well, it's very simple. You have call options and you have put options. What is a call option? It's a right, but not an obligation, very important, to buy an underlying asset at an agreed upon price on or before a specified date. Meaning agreed upon price is the strike price. That's a term you'll hear quite often in options land. And the expiry or the expiration date is the time until when the option exists. Most common options are monthly options. So they expire once a month. Usually that's the third week of the month. Around that time, around Friday, the third Friday of the month is an expiry date. So for example, if you say I'm buying an option on Amazon. Amazon yesterday had its earnings, and you believe that it will continue to rise. You could say, watch out, this is not advice, and this is just an example. Let's take what stock should I take? Now let's go on with Amazon. Amazon, you think, Amazon will go further up. And I believe it will do so in the coming month or in the coming 6 months. Well, let's say 6 months, then you'll take an expiration date where May. We are May, so it would be June, July, August, September, somewhere October or November. So the expiration date would be, I'm not 100% sure, I'd have to check. Let's say 17th November of this year. So that's the expiration date. And Amazon, I don't recall what the price is, but let's say you think the price will go to, I'm probably exaggerating, to 250. And so your strike price is 250. Your expiration date is November 17th, 2024. That gives you the right to buy that Amazon stock at 250 before or on that date. Put option, exactly what the prices are, we'll check that in a moment. A put option gives you the right, but again, not the obligation, to sell an underlying asset at an agreed upon price on or before a specified date. Again, the same thing, but what's the difference here? The difference is you have the right to sell, which means if you buy a put option, you have a right to sell something. Let's say stock ABC, because I won't use Amazon anymore. That would be too much of advice because I don't know what Amazon is going to do, and honestly, I don't care. But let's talk stock ABC. That's better. And the stock ABC is at 100, and you think ABC in the next 6 months, the numbers don't look good. I think ABC is going down, and it's going down to, just saying something, to 70 or 80. It's going to lose 20 or 25 or 30%. Well, at that moment, you could say, I'll buy a put option, which gives me the right to sell, for example, at 100, the current price, even though in the next coming 6 months, it might go down to 80 or 70. At that time, 6 months from now, and you were correct in your assumption, you could say, okay, the price is now 70, but I have a right to sell it at 100. That's my put option. So at that moment, I can sell it for 100 and buy it immediately back at 100, at 70 or 80, whatever the price is, and you pocket the, in case of, for example, 80, if it went from 100 to 80, you pocket $20 profit, while you only paid in a bit ago, we mentioned that the option would cost $10 on stock ABC. In this case, you would then pay $10 for a put option. You make 20, so you double actually your money. So, in short, call options are for if you think that the shares will go up. Put options are when you think it will go down. And once again, at an agreed upon price, the strike price, and at the moment of exercise and before or at the expiration, you buy or sell, depending on the option you had, at the market price. In the case of the put options, we were talking about if the market price is 80 at that moment, well, you have the right to buy it back at 80, while you actually have the right to sell it at the strike price. Okay. There is one distinction we have to shortly cover. You have American style options and European style options. What does that mean? That's a common, how would I explain it? It's a lot of people that think that American and European style options have to do with the geography, which it does. It's just a name. There surely will be a reason why they made that distinction, but in short, it actually means that if you have American style options, which are the most common if you have options on shares, as you can see in the graph, over time the option goes up or down, and any time in that before the expiration date, you can say, now I want to exercise my option. I want to really exercise my right I bought towards the person who sold me that option. I want to buy my shares, which correspond to my option, or in case of a put option, I want to sell those shares, and that can be any time before the expiration or on the expiration itself. The European style options are the same, but you can also only do it, the exercising, at the moment of expiration. Why is that of importance? Well, with single shares, sometimes you really want the shares. If you do it with indices or forex pairs, well, usually, like especially with indices, an index, that's something not deliverable. So there is often a cash settlement, and that can only be done at the end of the or at the expiration date. A very important distinction between those two. Um, but in reality, if you do shares, usually it's American style, and all the rest indices and forex are European style. Okay, let's have a look at some basic option strategies, namely long calls, long puts, covered calls, and protective puts. Uh, we'll cover it very shortly. Long usually means it's a term, if you're long something, that means you bought them and you hope that the value will go up. So you bought, you pay the premium, and the value should go up, be it by using a call or a put, the value will go up. That's the whole idea. Long puts is just the same. You buy a put option in the hope that you will make a profit. Then very shortly, covered calls and protective puts, which is a very basic hedging insurance strategy. Let's say we buy, I'll go in because time is moving fast. I'll only cover the call option with some numbers. In this case, we're looking at the US 500, so the S&P 500 index, which is in this case a CFD, because the actual S&P 500 index you can buy. It's an index, it's a calculation. So in this case, we're looking at the CFD. The price is at the moment in this graph at 4,436. Price will go up. Rather than buying the CFD itself, we would buy an option with a strike price of 4,500. So we strongly believe that the price will go up and above 4,500. You can see we buy, and well, I'll show that in a second with a normal stock option. You buy to open one option, and one option entails 100 underlyings. In this case, it would mean you buy 100 times the price of one, meaning the strike price is 4,500. We think that price will go higher than at 4,500. It is a call. We want the price to go up. And for that right, we pay $21.70. And that's for one option. That would need to be multiplied by 100. So the total price of this option contract would be 2,170. Okay, a couple of, how would I say, scenarios. First scenario, everything goes well. That's very nice. The price goes before the expiration to 4,550. Remember, we bought a 4,500 call. That means that we have the right to buy the underlying for the strike price 4,500. At the moment of expiration, the price is 4,550, and it cost us 21.70 per underlying in the option contract. That would mean that we have a strike price of 4,500. It went to 4,550. We would make $50 per share. So for the option contract, that would mean, so we paid 2,170. We got 5,000. So we would actually make on the whole contract 3,230 or $32.30 per underlying in the contract. Remember, we only invested 21.70 per share or per CFD contract in this case. If you would do that with the same underlying, with the underlying itself, we would buy one contract, in this case of a CFD. It could also be share, of course, if you talk about shares with companies, not indices. You would pay, in this case, $4,436.51, because that's the price where we enter the that's a very good. I see 28.30 indeed. I don't know how I came to that amount. That's probably with transaction costs. No, it's a mistake on my part. Excuse me, but I see a comment that it should be 28.30. 100% correct. That's a mistake of $5. Okay, that's a very good one. Thank you. Same with the. Oh, you really got me there. Very poor checking on my part. Anyway, the principle is the same. If you look at the cash spot position, you would buy the underlying, the whole price, going to, and you would sell it at 4,550, and then you will actually make 113, which is a lot more actually than with the option. But don't forget, you invested a lot more money, because if you would have to do it with the same amount, you should multiply it by 100, which is a much bigger investment. This way you can actually invest a lot less money and make a lot more money. That's the leveraging part. Rather the profits advantages. What if it goes wrong? It will go. Imagine it goes wrong. It goes down. It doesn't go to 4,550. Rather, it drops to 4,350. Well, we paid our option premium, $2,170, and that's the most we can lose actually. We can't. It's an option contract with an obligation. We don't have to fulfill any obligation. We can exercise that obligation, but we don't have to fulfill an obligation. So if the price goes against our views, we lose. That's the maximum we can lose. We lose what we invested. If we were to speculate or invest on the cash position or the spot position in the case of an index or a forex pair, well, there you would actually use the amount, the difference between where you bought it and you sold it, and that can be much bigger than you anticipate. Because people tend to hang on to their stock sometimes. You can say, yeah, but you can set a stop loss. True, completely true. And I hope most people do that. But I do know a lot of investors who never do that. They buy a stock and they believe it's going up and it's going down. And rather than selling it when it goes really down, they say, yeah, it will recover. It will finally be good again. And oftentimes, they end up with positions which cost them a lot of money. Something that can easily be avoided if you have options, because the maximum loss is defined when you buy the option. Another advantage is if you buy a call, in some cases, and I hope most of them do, you set the stop loss. And you say, okay, I position $21.7. The thing is, when that price passes that stop loss, the stop loss will be executed and you will get out of your position. At that moment, you have a realized loss. Your stock isn't there anymore. You sold it. You sold it at the stop loss price. With an option, if the expiry date is far enough in the future, it doesn't matter if it goes below that price or it stays above or it goes deeper and deeper. If the option or the price of the underlying eventually goes up, you still have your right to buy the underlying at a predetermined price. And here again, I have the same mistake again. Oh, what did I do? I did something wrong. My apologies. Let's go quickly to the same. Finally. Okay, we're almost there. I believe we were here. If you would have a stop loss, my apologies for the mistake. That mistake in the total profit really knocked me off my attention. If the price really touches your stop loss and then it goes up again, yeah, using a stop loss, you're out of your position and your loss is realized. While having an option, your option still stays valid till the expiration date. So if the price recovers, you will never lose more than the amount you paid, but your option is still valid. And if the price recovers, you can still actually make your gains, your profits. Okay, those are long calls. Very shortly on a risk profit kind of graph. If the price goes up, if the share price goes up, your profit goes up if you buy simply the shares. If the price goes up with €1, your profit will rise with €1. If you buy a call option, then the graph is a bit different because you buy, that's the price, actually the distance between the horizontal, the price, the share price, and the strike price is the cost of your option, and that's your max loss. Once your share price rises enough and you are more than the price you paid for the option, you just have profits. So you can clearly see your losses are limited. If we have a look at because I'm really running out of time, let's have a quick look at long puts. It's the same principle, but just as you really investing or speculating on the fact that the price will rise, here we are speculating on the fact that the price will drop. Same idea, just inverse. Okay. Then a short notice on covered calls. Covered calls are actually a share as Coca-Cola, which is shown here in the graph, is usually a strategy where you use calls, you sell those calls, you sell those options, and so you give somebody else the right to buy your stock at a certain price. And that's why it's called covered, because you have those underlying stocks. And if we have a look at the graph of Coca-Cola, that would mean that you have 100 shares of Coca-Cola and you sell one option contract, which covers 100 shares. And for that, you would receive a premium. And that is often used as a way to enhance, to improve your profits, your yields. You still think that Coca-Cola will go up, but it won't go up that fast. So in the meantime, you sell a call and receive some premium to get some extra income. Some people use that strategy as a replacement for dividends. Stocks who are uh, you bought and you think they will, in the long term, they will go up. Well, you sell covered calls, and that's some kind of equivalent of a dividend. Okay. Protective puts is another way of using puts, and I think we already covered that. If you want to, if you bought a share and you think, common example, of course, is for example Nvidia. Nvidia had an enormous run up, and you think, yeah, it's gonna be faster someday. But I don't want to lose my profits. You could actually buy a put, which protects your position in Nvidia. I'm not saying you have to do that, because you never know what Nvidia will do. But you can buy a put, and that would act as an insurance if the price goes down. And your maximum loss is the price you paid for the put option. Okay. My time is really going fast. A short notice about the Greeks. What are Greeks? Yeah, I definitely won't explain it here because that's too complicated and definitely not the purpose of this webinar. I just want to mention what they are and why, because if you want to do something with options, you'll hear those terms, the Greeks, delta, vega, gamma, theta. What are those? Well, I talked about stock ABC, and that you could buy a call option, for example, for $10. But where does that $10 come from? Who determines how much that option will cost? Well, ultimately, it's determined by the market. You buy the option and you buy it from somebody who sells, and it's the market who decides what the actual price will be. If you say, okay, I want to pay $15 rather than those 10, and the seller agrees with that, well, that's going to be the price. But of course, we have to, in the software, you have to see those prices, even if there aren't buyers. And then we're talking about a theoretical price. That's maybe not a price you will get, but it's an indication. And to do that, they use complicated mathematical models, and the Black-Scholes model is the most common one. I won't even show it here. It's not necessary. It's just, you just have to know there is a complicated mathematical model. The prices don't show up anyhow. It is calculated. And the price of an option is determined by a couple of important factors. Usually, the price of the underlying asset, the price you agreed upon, the strike price, how many time till expiration. An option that is valid only for a day is usually much cheaper than an option that is valid for a year. The risk-free rate of interest and the interest rates, and of course the volatility. How is the market? What is the market? What does the market thinks that this price of the underlying will do. Will it move a lot? Like something that is very volatile is, for example, Bitcoin. Bitcoin is known as to be a very volatile thing. If you look at, for example, the gold is a bad example because the volatility now is also big. But you have, for example, I showed you Coca-Cola. Coca-Cola is a much less volatile asset. So those factors determine actually the price of um, an option. And then the Greeks themselves, we have a couple of them: delta, gamma, theta, vega, and rho. They all correspond to those factors, and that means actually that if you see a certain value displayed in the platform, you know that it has effect on, and delta, for example, is a direct relation with the price of the underlying. Theta has a relation to the duration, the time till expiry. Vega, it has to do with volatility, and the rho about the interest rates. That's all I'm going to tell about this, because much more you shouldn't know. What is of importance is that those Greeks are used for various number of things. It can be something predictive, or it can be used in risk management. Okay, I'll leave the Greeks for what they are, and because, yeah, okay, we'll move on to the demo. For that, I'll switch to uh, uh, my demo platform. Again, this is, as you can see, it's a demo account. I can do anything I like without having to worry. Unfortunately, we're the 1st of May, and we're still before the actual, so the European exchanges are closed, and the US exchanges aren't open yet. So I can't really show something live. I was talking about options. Well, here at the top, you say, for example, I want to do something with Amazon. And we'll go and have a look at the stock. Okay, we're going straight to the charts, because usually you start from a certain view. You think that something is going to happen with the stock or with your position. The stock has been going up, it went down, and now you could say, yeah, I still believe that the stock will go up. Okay, so you could say, I'll buy a call option. So how do you do that? Well, you first go to the options chain. And what is the options chain, or the option chain? The options chain is actually a list of, let's see, we'll take this one of this Friday and somewhere in September, just to show you what I mean. You get a list of the expiries. All in stock. This one is expiring in 2 days, this one in 142 days. If you click on, if you expand that certain expiry, you will see here all the strike prices which are available. And since the exchanges aren't open, all these values are empty, unfortunately, but you can still see the last traded. Oh, I hear comments that the sound is really bad. Is it still? Is it better or not? Okay, I'll continue. I hope it gets better. So we have the May expiry and you have the different strike prices. On the left-hand side, we have the call options. On the right-hand side, the put options. So that means that if you, let's go back to our chart. Imagine you still believe that the price, let's say you really think it's going up till 200. You say, now, yesterday it was a bit down. It's a good moment. Buy the dip. I'll buy a call, and I believe it will go to 200. Personally, of course, you have to think about, is it going in what time frame will it go up to 200? If you say before the 3rd of May, you already know that cheap. Why? Because the chance that it will get to 200 before Friday is very, very low. So your option will be very cheap. That doesn't mean you can't make money with it. It just means that in order to be on the expiration date, so in 2 days, this Friday, at 200, chances are slim. But imagine it goes up, the price of that option will go up very fast, even while you can't exercise it before Friday, you can resell it before Friday. I would make an anecdote of a colleague, but I won't. We don't have time. Would be a nice anecdote. He made in a virtual trade a lot of money. It was virtual money. We have a contest. But it would have been nice to show you that. So we have the call option, and on the right-hand side, the put option. Imagine I say, okay, well, I still believe that Amazon is going to 200. Let's have a look at the September. That's a bit more realistic. Again, it's just an educational showcase. I don't have any views on Amazon, nor up nor down. I really don't know. It's just to show what's possible. Imagine we had in the chart, we believe that it will go to 200, and we think it will do so before the 3rd week of September. We could buy a call option, and the last traded price was $7.52. That would mean that if we buy, and to buy one, you'll have to, that's a bit a pity we don't see the bid and ask prices, but you'll have to click on the ask price to buy one. If you want to sell one, you'll have to click on the bid price. We'll click on the ask price, and here it shows that price again. So what do we see in this trade ticket? It's about Amazon.com, expired September 2024, a 200 call. That means the strike price is 200. We'll have the right to buy Amazon at 200. And for that right, we'll pay 7.50. What does that mean? It means that if the price before or at 20 September of this year will be more than 200, we can actually exercise our option, which would mean that we can buy it at 200 and then sell it immediately at the price. And when will be that interesting? If the price is, for example, 220. I'm just saying a number 220. I have the right to buy it at 200 and I can sell it immediately at 220, pocketing $20, and I paid $7.50. So I would make $12.50 based upon my investment of $7.50. That would mean that the break-even price at which point the option becomes interesting is the sum of the strike price and price I paid. In this case, if the price is more than 207.50, I will start making money. Anything less will have some loss. Between 200 and 207.50, I have partial loss. Everything below 200 will be a full loss. And what is the full loss? 750, that's the price I paid. 750 times 100 is 750. I get a question, do you have to own the underlying stock to buy a put option? No, not at all. Options are tradable without having the stocks. You can, and that's actually a way of shorting a stock, which is with stocks impossible, or at least in Europe, it's not allowed. If we have a further look at the trade ticket, what is important to know? Well, it's American style. The settlement style is physical. That means if you exercise it, you will get the Amazon stocks delivered into your position list, into your account. And the contract size is 100 shares. That was a call. The same goes, for example, if you go back to our chart, and if you think that the price before September here will go to rather than 175, it will go down, let's say 150. That would mean, okay, again, we're going to expiry 20 September, and you think it's going down at 120, or let's say you think it's going to 150, you could buy a put at 170 or 180, and you would pay again, let's say you take the one at 70, that means you have the right to sell Amazon stock at 170, and you pay $10.30 per action, per share. That would mean that the price would have to go below 170 minus 10.30, so below 159.70. At that point, your put option would become very profitable. I see, by the way, are the contracts always 100 shares? In 95%, maybe more, 99% of the cases, yes. You do have shares where, for example, you only have 10 shares. But usually that is specified then in the contract size field. Okay, so this is, I'll keep it at that. Maybe interesting to know is if you click on the strategies button here, you can actually see a risk graph, which is if you buy to open a call on, for example, just showing something real quick, 175, a call, that would mean you speculate on the rise of the price. You could actually see how much you pay. The traded price, it will have to go above 188.05 to be profitable. Okay, let's now have a quick look at some questions. By default, options data is 15 minutes delayed unless you buy the real-time services. Indeed, you have to buy the real-time data feed. Again, I agree, you wouldn't need that. Personally, I use it. But again, if you're working with options on a bigger time frame, like let's say a month or 3 months, Will that 15 minutes make such a big difference? Honestly, I don't think so. It's only very interesting if you're really very active with options, and also on the shorter time frames, like you have what they call zero DTE options. Those are options which expire the same day. Their 15 minutes is a long time, and there you definitely need it. Is it right that being a seller is more profitable due to implied volatility? That's a very nice question. Well, you can discuss a long, you can have a long debate on that. Yeah, it's hard to say. In the beginning, I was really convinced that selling options is the way to go, and I still believe that. But in many cases, buying options can be very profitable too. The main advantage is, of course, that when you buy options, your risk is defined. You always know what your maximum loss will be. If you sell options, you really have to know what you're doing, because it can turn out very bad very fast, and way more than the size of your account in some cases. So you really have to know what you're doing. So it's a warning I'm giving you. I do it a lot, and personally I love it, but you really have to know what you're doing. So definitely in the beginning, stick to buying options. You'll sleep better at night. If you exercise a call option and the settlement type is physical, how many shares will you receive? Well, that's let's if we click here on any option, physical contract size 100. If you have one contract, you will get 100 shares delivered. If you have 10 contracts, yeah, you'll get 10 times 100 shares. So 1,000 shares. Multiply this. I see here somebody saying the FTSE contracts are 1,000 shares. Definitely possible. I know, for example, Adyen, I believe it's Adyen stock in the Netherlands is only 10 shares. So there are variations. How can I see what stocks have an options chain available? Is there an easy way to see rather than click on each stock? That's a very good comment, very good question. Unfortunately, at the moment, that's the only way to know. So, unfortunately. In your experience, how far is the optimal time to sell the option? And I know it depends, but just out of your own experience. Okay. Very good question, very difficult to answer also. You have quite a few research has been made that an optimal time to expiry is around 45 days. That's a common used time frame. So research shows that the price of an option starts to go down once you reach 60 days from expiry, and then it goes faster and faster, and then the last 7 days it really goes super fast down. So the value, your value of your option is really losing its value very fast in the last few days. So it depends. Yeah, I've seen clients who have options. Personally, I rather, if I believe in some stock that it will rise over a long term, why wouldn't you take an option with an expiry date of a year or even 2 years from now? On the other hand, if you speculate on something, well, this afternoon we have the Fed interest rate decision, and then the press conference afterwards, everybody's looking at that. And yeah, you have people who speculate on options which expire tonight. So which one is ideal? It depends completely on your style of trading. Are you somebody who likes to look far ahead? Take a year. If you really think the price of this stock I'm investing in will get influenced by the coming earnings release, well, then do a time frame of 3 months, for example. Do know that if you buy options, options lose value the more they reach their expiry date. So if you think, for example, I'm just giving a quick example, and I'm running out of time, way over my time. So I'm very pleased that a lot of people are still there. So we must be talking about some interesting things. But if you buy an option and you say, for example, I think let's take stock ABC, and it has the 1st of May, and the numbers released is on the 1st of June. Just fictitious case, we have a month, and you think that the stock ABC in the coming month, you think really the 1st of June they release their numbers. I think stock ABC, it's at 100 now. I really think it's going to 120. Now, it wouldn't be smart to buy an option with an expiry date of the 2nd June. It's better to always take the expiry date a bit further. So if you expect a price move within a month, be sure that expiry date is 1 month and a half, or even 2 months. Why? Because as the price comes near the expiry date, your value of your option will start to lose extrinsic value, as they call it. The time value will shrink down, and if you're not completely correct in your assumptions, you might lose everything, even if you were almost correct in your vision. So always take a bit further than your actual price point or prediction. Okay. Will you do also a bit more advanced webinar in 2 weeks? I'm not sure if it's going to me or my colleague Dan, who is going to do that. We'll see that. I appreciate your honest and practical answers. I'm trying. What if the seller is manipulating a call with short selling around the strike date? What if the seller is manipulating a call with short selling around the strike date? Definitely possible, but again, it depends on the underlying. If it's an underlying with very small volumes, maybe that will be possible. But if you try to do that with a stock like Amazon or Apple, you'll need big pockets to do so. But it is theoretically it's possible. Okay. I'll keep it at that because we're already at 1 hour and 15 minutes rather than 1 hour. I do see an interesting question. What is considered to be a reasonable percentage return on an account for a professional options trader? That's a very difficult one. From 0 to 100%. I'm just saying something. It could be anything. I've seen all kinds of numbers, and you have good years, you have bad years. I've seen people who easily make 100%, and I've seen as much people who lost 100%. It's very difficult to say. It's a thing with experience. You win some, you lose some. And of course, using options, you can try to flatten the curve, that you don't have things going up and down, that you have a nice flattened curve that goes up. That's always the intention. But there's definitely no guarantees. It's a leveraged thing, so you always have to watch out. Okay, but I'll leave it at that. I hope you enjoyed this session. Let me see, just a couple of things to close down. If you want to dive a little deeper, my colleague Peter Six and me, Peter Six is a Dutch options or actually instructor of Saxo. We made and still making podcast series, the Saxo Options Talk, in which we dive into all things discussed here and a lot more even. Just go to Google, type in Saxo Options Talk, and you'll find it. It's either here on our site or on Podbean. That's optionstalk.podbean.com, and there you also arrive in those podcasts. Okay, I'll leave it at that. Remember, in 2 weeks there's another one. And once again, thank you very much for your patience and your being here. Thank you. Bye.